Estate experience is essential to understanding the complexities and opportunities of this sector. In our case, both Charlie and I have accumulated a considerable amount of experience in this field, which has provided us with valuable insights and effective strategies. Charlie, in particular, achieved financial success relatively early in the real estate sector, which demonstrates not only his ability to identify opportunities, but also the importance of having a deep understanding of the market. When investing in real estate, experience can make all the difference. It allows us to understand market nuances, correctly assess the value of properties, and anticipate trends that can influence asset prices. Experience also helps us develop a network of contacts and build relationships with professionals in the field, such as brokers, appraisers, and property managers, which can be essential to the success of a real estate investment. Importance of the second point. The second point we've covered is crucial to understanding the real estate market. Unlike many financial assets, real estate should not be treated as a commodity. This is because the value of real estate is not determined solely by general market conditions, but by specific factors that affect each individual property. Critically priced properties are those whose values are established based on a detailed and accurate analysis of the market. These prices are often adjusted to reflect not only current conditions, but also future prospects for the area where the property is located. This means that a property with a well-priced property can offer a more predictable and reliable return compared to those whose prices are less accurate or based on superficial assessments. In short, real estate experience and a detailed understanding of property prices and values are essential elements for success in real estate. Having in-depth knowledge allows you to make more informed decisions, identify valuable opportunities, and avoid common pitfalls, thus ensuring a more solid and sustainable performance in the real estate market. During the Capital Transaction Network (CTR) era, many mispricings were common due to the large volume of transactions and the lack of clarity about the true nature of the assets in question. At that time, it was common to find situations where owners and investors were dealing with properties whose true value was difficult to determine. This situation was compounded by the fact that many investors did not want to own on a large scale and often did not have a clear understanding of what they owned. As a result, many errors arose in the valuation and pricing of properties. Some people have managed to profit handsomely from these pricing errors, taking advantage of discrepancies between the real value of properties and what was being charged. However, finding truly mispriced properties has become increasingly difficult. The situation has changed over time, and today, the market is much more sophisticated and competitive. Today, by analyzing transactions conducted by real estate investment trusts, REITs, it is possible to obtain a wealth of detailed information about properties and their valuations. Despite intense competition and abundant information, there are still occasions when unexpected events can lead to valuation errors. However, conventional wisdom, based on up-to-date analysis and data, generally prevails, making pricing errors less common and harder to find. Most valuations and transactions reflect a fairly accurate understanding of the true value of properties, although the market continues to be dynamic and subject to occasional fluctuations. In real estate, opportunities can arise at unexpected times, especially when the market is in the midst of a period of financial instability. Chaos in real estate financing, which can manifest itself through fluctuating interest rates, restrictive credit policies, or an economic downturn, can create windows of opportunity for alert investors. These turbulent times can result in advantageous offers, whether through undervalued properties, aggressive negotiating opportunities, or favorable market conditions for acquisition and development. However, it is crucial to be prepared and have the financial resources to take advantage of these opportunities when they arise. This may mean having access to sufficient liquid capital to cover investments and deal with potential mispricing. These opportunities often require investors to act quickly and accurately, taking advantage of discrepancies in prices and market conditions that may not last long. Furthermore, competitive advantage in the real estate market can depend significantly on the corporate structure under which one operates. In many situations, experienced real estate investors may not have an intrinsic advantage beyond their knowledge and experience, especially if they are operating on their own funds. However, a corporate structure, such as the use of a corporation taxable under Chapter C of the Internal Revenue Code, can introduce an additional layer of complexity. Such a structure may result in corporate taxes being owed on income generated by real estate ownership before the proceeds can be distributed to the owners or shareholders. Therefore, the way you structure your real estate operation can have significant implications for its financial efficiency and how you handle revenue. In some cases, you may need to consider different tax approaches or corporate structures to optimize your results and maximize the benefits of opportunities that arise in the market. It is always advisable to carefully evaluate the tax and financial implications of your corporate structure and seek expert advice to ensure that you are positioning your operation for maximum competitive advantage. The tax code can present significant disadvantages for real estate investors, especially when it comes to corporations taxed under Subchapter C. The tax structure associated with these corporations is often not ideal for real estate investing, resulting in a challenging environment for maximizing returns in this sector. This is due, in part, to the combination of a tax structure that tends to be unfavorable and a lack of real estate expertise. C corporations often do not devote much time or resources to real estate investing, which can limit their opportunities and effectiveness in this market. Furthermore, the standard corporate structure, such as a C corporation, is not the most advantageous for real estate investing. While some C corporations are actively involved in the real estate industry, other structures tend to be more suitable. For example, structures that offer more flexibility and tax efficiency, such as limited partnerships or limited liability companies, LLCs, often prove more effective for real estate investors. The C corporation structure may not be well suited to the specific needs of the real estate market, resulting in a disadvantageous combination that does not compete favorably with other, more specialized entities. Thus, the structural disadvantage and competitive nature of investors with more suitable structures make it difficult for C corporations to achieve outstanding results in the real estate industry. During the RDC period, we faced a challenging environment that directly impacted our ability to seize valuable opportunities. Charlie stated that due to our structure and the intense competition in the market, it was unlikely that we would be able to capture large opportunities. The market at the time had a number of inefficiencies, and there was a shortage of financing, which severely limited the possibilities for significant transactions. Although we did come across some interesting opportunities, none of them had a significant impact on our total capital. One of the few opportunities that we really considered seriously was the acquisition of the Irvine Corporation. At the time, in 1977 and the following years, the Irvine Corporation was available for acquisition, and it was a possibility that we evaluated very carefully. However, we were unable to complete the acquisition. This was one of the main opportunities that stands out in my memory, especially since Mobil Oil was also interested in the acquisition and Don Brent ended up forming a group to try to acquire it. While there was potential for something significant, it was highly unlikely that such an opportunity would be realized given the context and circumstances at the time.